So good afternoon, everybody, and thank you for joining us. We're going to have a fantastic panel seminar, online seminar on banking consolidation. The title Is the Time Right for a Wave of Banking Consolidation? This is part of the Bank Board Academy. We're going to organize a specific academy on that on October 24th and 25th in the wonderful Florence. The title of it is going to be New Risk and Opportunity for Bank Boards, Leveling Up. In that course, we'll cover performance, dynamics, structuring, efficiency of bank board, geoeconomic and geopolitical risk, bank consolidation, risk culture. We're going to organize that together with the ECB, Spencer Stewart, and Lazard. So we have today a fantastic panel covering this issue. We have four panelists. They're going to speak 7-8 minutes each, and then please feel free to ask questions in the Q&A box. So since the great financial crisis, banking regulation have largely focused on targeting the too big to fail firms. Yes, yet in several subsequent crises, including the 2023 banking turmoil, too big to fail appears to have been the solution. Today, Europe is seeing increasing efforts to consolidate its fragmented banking sector, taking further steps towards the banking union. From several SSM chairs, there was been always the call for more cross-border consolidation. So we're opening today the floor. We have Andreas Dombret joining us, a global senior advisor at Oliver Wyman and former member of the executive board of the Deutsche Bundesbank. Thorsten Beck, director at the Florence School and Banking in Florence here at the UI, and is also co-chair of the Advisory Scientific Committee at the European Systemic Risk Board. Corso Bavagnoli, managing director at Lazard, and also former official of the French Treasury. Then we also have Sharon Yang, former managing director at JPMorgan and deputy assistant secretary at the US Treasury. So I will kick off with Andreas, who can give us an overview of the market situation and trend in the EU. We see in Europe increasing efforts to consolidate its fragmented banking sector. So please, Andreas, what you can tell us about that?
Thank you, Emiliano, and hello to everybody online. Thanks for the invitation for this webinar. As Emiliano said correctly, I've been both an investment banker. He didn't mention that part of my life, where I did M&A and executed M&A transactions, mostly across Germany, Austria, and Switzerland. And then I was a central banker. So I've been in both sides. I'm still the only one who has been on both sides of the aisle, so to say. And thanks again for the opportunity. Now, 30 years plus, I should say, of M&A history has some clear lessons for us, I believe. While results have been underwhelming of bank M&A, in market, or as we would say, domestic transactions usually are accretive, and cross-border transactions are significantly less so. There is a lot of academic work on, giving evidence about that. Underperformance, which I just highlighted, is idiosyncratic and largely due to two major drivers. Either assumptions, ex-ante assumptions, are over-ambitious, or I should say, we see flawed execution of these transactions. There can be several reasons why these executions don't really work out. There, very often you'll see a cultural clash. You see a slippage in the first year in terms of clients, in terms of balance sheets. Sometimes you also see reputational slips. Litigation legacy moves in, and quite often you see what I would call Gordian knots in terms of legacy IT. So there are some reasons why this would happen. However, and having said all what I did, European banking needs consolidation, and I'd like to point out why that is the case. There is no obvious organic fix, I would argue, to current profitability and ROE challenges in the European bank market. And what needs, where are the challenges the highest? Let me say some of the reasons. We have fintech price points and margin erosion because of fintechs. We have the interest rate environment, which was hurting us a lot during until the change in interest rate policy and monetary policy of the ECB. We saw legacy infrastructure cost. I mean, a lot of cost inflexibility. We see persistent non-financial risk costs. Think of anti-money laundering, think of conduct, etc. And we see ongoing cost of digital transformation programs. So there are challenges, not only for European banks, but also for European banks. In addition, we see real political and competition concerns limiting the scope for domestic mergers in most markets. Labor rigidity limits the cost synergy realization in many countries. So this is why cross-border transactions do carry structurally high inherent risks. And I would like to mention some. Limited capacity reduction in the markets, but, and there comes the big important but, significant economic upside via an M&A transaction in moving to next generation digital capabilities, releasing legacy infrastructure and streamlining business processes, etc. So if you are willing as a bank to do significant upfront investment and you're willing to accept a medium-term payback, that could be a solution, but mainly a solution for large players with major investment capacity. Now, in all of this, and it was mentioned by Emiliano at the beginning, supervisors can play actually a quite powerful role in risk mitigating major transactions. And they can do that by recognizing the importance of realistic expectations, thorough planning, and disciplined execution, as well as the scalability of digital operating models. So the ECB, as mentioned, is playing a very clear has a very clear position on this regarding bank M&A. If we go a little bit more to the facts and figures, the concentration in the European banking industry has increased actually very slowly since 2005. Albeit with significant cross-country differences, whilst the share of total assets by the largest credit institutions in each country has been increased over time, the market concentration remains varied, with quite significant changes for most economies since the financial crisis. Notably, exceptions are Greece and Spain, but otherwise this holds true. So the European banking industry presents stark differences across market structures, as we all know, while, as I mentioned, facing significant challenges ahead. And let me summarize the 5 biggest challenges for the European banking industry. First, what I would call depressed business models and profitability, rather low profitability. Second, digital and tech diffusion. Third, changing customer demands and new competitors entering the markets. Fourth, regulatory environment. And last but not least, legacy culture inhibiting transformation. Now, these are the challenges which in bank consolidation you have to be thinking about. Since the crisis, we have seen capacity reductions in the European banking market, but if you analyze it more closely, you basically see these capacity reduction manifesting itself mainly in branch infrastructures. So branches have been closed rather than banks have been really taken out of the market. And these trends we are seeing in Europe has led to calls for increased consolidation in the banking sector, including, of course, cross-border deals. And I would like to quote 2 institutions. The first is the SSM, the Supervisory Board of the ECB, where I was a founding member, and Andreas and Ria actually had, and I quote him here, said, "We need to deploy policies to restore and improve the integration of our banking markets, to favor consolidation and cross-border consolidation, possibly by banks." And the IMF in its Global Financial Stability Report, and this meeting is about financial stability, has said weaker banks need to be consolidated into stronger ones and costs need to be reduced. And I'll end the quote there. So actually, I was one of the voices when I was in office who has called for more bank consolidation. Now, if you look at the last 3 decades, more or less, you have seen several rationales. And while we have firstly, at the beginning, we saw opportunistic consolidation, especially vis-a-vis distressed banks. Now you see a lot more bank consolidation addressing regulation and pressure in revenue cost and digital transformation. And interestingly enough, the transactions we have seen in 2000 to 2010, you know, what we are seeing now is a lot smaller. It's around about a third in terms of transaction value. The average size of transaction has halved, whereas domestic versus the split between domestic and cross-border has actually not changed a lot in this time. Now, let's look at synergies, because if you do bank consolidation, that's what you're really mostly looking at. And there are 5 synergies and 5 sources of synergies you would be looking at. First, and most important, cost synergies triggered by an increase in scale. Second, revenue synergies. You normally have revenue synergies when the combined entity is able to generate more income than the 2 companies would separately. Third, RWA density synergies, where you look at a decrease in the price of new debt issued. 4, funding synergies. And 5, reduced cost of capital. So these are the 5 boxes which analysts normally would look towards ticking and understanding what has to be done. Many times, cost synergies are in fact hiding a restructuring of the standalone cost base. And why is that? Because evidence suggests, and Thorsten Beck can speak about that, that size does not drive efficiency in most cases. So it's not necessarily the size which really drives efficiency, but other reasons. Now, the most problematic synergies are revenue synergies, because they are most difficult to underwrite and even harder to deliver, and also quite difficult to monitor over time and to understand. So revenue synergies, you have to be careful when looking at a merger, because they do have a disproportionate impact on success, and they are the least controllable by management. Having said all that, M&A transactions are not only about synergies, they are quite often triggered and influenced by considerations well beyond synergy potential and well beyond fair pricing, unfortunately. There is an emotional consideration also part of a M&A consolidation. Now, M&A will continue to take place. What you really need to do is, and you have to look forward to, you have to be a very disciplined acquirer or a disciplined merger partner. Otherwise, you get into all sorts of problems. Now, Emiliano, and I have to be quick, also mentioned too big to fail, which brings me to this issue of resolvability. And this resolvability is a powerful lever in reducing the risk profile of a complex cross-border banking group. So here we do have financial stability issues at play. If there are supervisors involved, I believe, as a former supervisor, that should be focused on insolvency and operational continuity, and that this should be the 2 parameters they should be looking at most. So where are we today in terms of M&A market in the EU? Let me make 3, 4, 5 points. First, in principle, we are in a market-friendly environment. The ECB is welcoming consolidation. We now have quite a large German new fiscal program, but we have high uncertainty due to Trump 2.0 policies. Second, the M&A moves we are seeing are still mostly domestic ones. In Spain, we see BBVA, Sabadell. In Italy, we see UniCredit, BPM. We see Montepaschi di Siena and Mediobanca. In Germany, we see UniCredit Commerzbank, but that's basically an Hypovereinsbank Commerzbank, so it's even more of a domestic move than anything else. And in outside but close to the EU, you see UBS, Credit Suisse for different reasons. Third, challenges are still there, and they're still the same. It's still about business model and profitability. It's still about the regulatory environment, and it's changing customer demands. But we have a new main reason, and that is we have more and more disintermediation of banks in the markets. We see private equity, we see private debt. We see the payments market being, seeing a lot of intervention. Potentially, even the ECB is going to intervene in the payment market with the digital euro. So you see that all of this is eating into the bank's profitability and is a major concern going forward. So banking markets need integration is my very big conviction. For that, we need the third pillar of the banking union. I'm sure we're going to talk about EDIS in the not too distant future during this webinar. So my summary would be bank consolidation is positive for EU financial stability. Let me stop here.
Thank you, Andreas, for this very comprehensive overview. Really, you touch all the points. The challenges. You started with saying the banking consolidation is needed. You focus on the national concentration, the role that the SSM, IMF had also in advocating for that. You mentioned the synergies. I mean, probably we can expand also on regulation, or what the regulation, what kind of role regulation actually play. But let's start with first with Thorsten. So focusing on the financial stability aspect. So is banking consolidation bringing more financial stability or not? Thorsten, please.
Thank you very much. So I'm going to come from a very, very different perspective than Andreas, but I'm probably going to end up in exactly the same spot. But so let me, and I'm speaking here first as an academic, but also somebody who has also been involved in policy work. So if you look at the arguments, there is in economics, we'd like to call this the stability competition and the fragility competition argument. So where it says that either competition is good or is bad for stability. And the argument kind of goes, well, competition can be bad because more aggressive risk-taking, the banks lose their franchise value, and then ultimately there are more failures and more distress. And sometimes people point to the period after the liberalization in the US, for example, in the 70s and 80s. There's the other argument that if you have more competition, actually banks become more stable. They compete on efficiency. They compete on customer service. And also so they ultimately they make the financial system more stable. Now there is a kind of related, and that actually gets also to the conciliation debate on kind of bank size, because competition you might think might imply having lots of banks and having a very kind of dispersed financial market, and that of course can also kind of bring diversity with it. Whereas on the other hand, if you have very large banks, if you have consolidated banks, then you have the too big to as already mentioned by Andreas. So there are arguments on either side. There are arguments that focus more on the market structure, small versus large banks, and more on the degree of competition in the market. Now, if you look at the evidence, the broad evidence is basically goes kind of different ways. So there's evidence that yes, more competition is actually good in the financial market, but also having large banks can be good, having concentrated markets. And basically what this tells me is that maybe there is not a one-to-one mapping. Maybe there's not a perfect correlation between the actual market structure and how much competition you have in the market. And again, the US in the 70s and 80s is partly an example because you did actually have a lot of consolidation after the branch deregulation episode, but you also had more competition. Why? Because the market, the state level markets kind of grew into a national market. And then similarly, of course, this competition then turned kind of very negative for stability back in the early part of the century, which again, but was partly due to regulatory environment supervisory environment, macroeconomic environment, which is another important point I want to make here, is that it's not only about the degree of competition, the degree of consolidation, market structure, but it's also in what kind of macroeconomic regulatory framework we are actually working in. And of course, the too big to fail is one of these issues. Now, how do I take all of this back to Europe? And now I'm kind of converging on where Andreas ended up. I think the discussion, and again, so Andreas, you mentioned the concentration ratios on the national level, but I think that's exactly the point. We have to move from the national level up to the European level. If we looked at the euro area level, the banking system wouldn't be concentrated at all, right? But we cannot really move up there because although we do have supervision and somewhat resolution on the euro area level, the backstop, the crisis management, deposit insurance is not there quite yet. Taking these two things together, large banks can be good, but we have the problem on the national level of too big to fail. Competition can be also good. Well, if you take this together, maybe we need more large cross-border banks on the European level. Large banks, and you said yourself, size by itself cannot drive efficiency, not by itself, but it can be an entry point into more efficiency. And again, if you look at all of these rankings in terms of investment banking, corporate finance, merchant acquisition, and so on, you typically see out of the 10, you see 7 US banks, 6, 7 US banks, sometimes a Canadian bank. You see 1, 2 UK banks, and then maybe you see 1 French bank or 1 Swiss bank. And I think partly, I mean, there are many reasons, and you know better than I do, Andreas, but I think scale is one of the issues that is kind of lacking in terms of European banks taking on a bigger role in this kind of market segment, and ultimately also supporting, as you said, financing of the European transformation and the savings and investment union. For the savings and investment union, it's not just about capital market union. It is also about having more efficient banks. Now, again, if you go from the idea of going from national champions to more larger European-wide banks, then of course we're moving to a very different kind of approach in terms of both market structure and also competition, because then we can ultimately talk about this on the European level. Now, in order to get off there, of course, we need also to bring up, as Andreas pointed out correctly, really a EU-wide or at least Euro area-wide approach. Unfortunately, I think, and Andreas mentioned lots of reasons why cross-border mergers might not work. Let me add one more. I think the reason both why we have not seen the completion of the banking union and at the same time we have not seen more cross-border merger, I think the reason behind it is the same. It's the what I would call banking nationalism. And of course, we just had recently, a couple of months ago, and still ongoing, I guess, the example of German resistance against the takeover of Commerzbank by UniCredit, which I'm not going to start discussing on the merit of the specific case. I'm just saying there is this, it's a good example of why banking nationalism stands against the idea of really creating a true single market in banking, at least within the euro area, hopefully within the EU. So I think overcoming this will really help us to get both to more cross-border consolidation as opposed to national champions, ultimately bring more competition on the European level, and therefore by definition on the national level, and ultimately might also make it more stable, because banks can be more diversified across Europe and they're not really kind of too close to national governments. Of course, there's always the risk to get too big to fail on the European level, but I think that this is somewhat less of an issue as we've seen it than at least currently than on the national level. Let me stop here. Thank you.
So thank you very much, Thorsten. You mentioned indeed the competitiveness element, the scale. You introduced the concept that probably we need to develop about international competition, no? And you mentioned the ranking, EU banks towards the US. Maybe we can come back to that, or maybe Corso can already expand on that. So Corso, now to you. Does scale enhance competitiveness and efficiency in the banking sector? I think I shocked you with a question, probably. Or we lost you. Or maybe we can, here we are.
Oh,
Corso.
sorry, apologies. I had a problem with my device, which is not yet totally solved. Should be better now. Can you hear me well?
Yes, please.
Yes, indeed. No, trying to answer your question, Emiliano, I think it's perfectly phrased, and trying to delve on the section about scale enhancing competitiveness and efficiency in the financial sector. I think it's a complex debate which has been going on for years, I would say, and which boils down to the point as to whether, seen from public policy, whether should regulatory policy or public policy in general encourage, discourage, or simply be neutral with respect to bank scale. Because I think it's quite straightforward to argue that I would say a pure economies of scale logic. The more you integrate, the more you reach scale, the more efficient you get, up to the limit that you run into for the financial sector, but for any sector in the economy likewise, which is the complexity to manage larger organization. But that balance has to be the same as in other sectors. I think the specificity of the financial sector is whether prudential policy has a view or should have a view on the scale of banks in its pursuit of the proper management of systemic risk. So now, that's how I would try to phrase the debate. Now, when you look at evidence, and in particular the European markets, and I think it would be interesting also for Sharon to share our view on the US market, but starting with the European market, where have we seen scale in the financial sector? I think it's fair to say that in investment banking, in the last 15 to 20 years, and since basically the global financial crisis, you've seen a very significant concentration of players in the European market, which has been mostly organic, and which has translated in big US banks taking a bigger share of the European CIB market over the years. I think the usual estimate that everybody cites is 10 percentage points of market share gain over that period by US banks compared to European peers for European CIB. So there, I think, a clear trend towards scale with very large players taking very significant positions on the market. That's the first area. A second area is what I call, verticals or products. So I'm talking here about asset management, insurance, leasing, those kind of products that, in Europe at least, tend to be distributed in the banking channel. Not solely, of course, but at least partially, and in some markets, predominantly in the banking channel. In that domain, you've seen also clearly consolidation and scale. We've seen, pan-European asset managers emerge. We are seeing some pan-European asset manager currently trying to emerge. So clearly a consolidation move. The same, I think, is true in leasing. The same is true in insurance. So there again, I think we've seen scale being achieved and being the strategy of the successful strategy of players in the market. Conversely, and I think it's very important to notice and to discuss, when you look at retail banking, you tend to see the opposite. And I think that runs into some of the remarks that were done by colleagues earlier. It's hard to see a real consolidation in retail banking in Europe over the last years. And I think significantly, no acceleration of consolidation since we've had the banking union back in 2013. Whilst one could have expected that would have helped to consolidate the market. But that trend, in my view, but happy to discuss that, is simply not there. So and the markets remain largely domestic, if not regional, in some countries. So there, it's hard to see again scale strategies being implemented successfully or just occurring in the market. So this is to say that when you look at this issue, I think you have to look at sub-markets, and the dynamics are pretty different according to markets. I think the second point I'd like to elaborate on is scale bringing better competitiveness and efficiency, which was, by the way, the initial question you asked. I think to that point, broadly speaking, the answer is yes. I think the key question here and especially for policymakers is, should it be encouraged? Clearly, the more efficient the financial sector is, the better, I would say, the outcomes for the economy and the macro. The more diversified the financial actors and financial players are, the more I think you mitigate risk, be it through balance sheet or P&L. And I think it's not recognized in banking regulation, but that you know that in insurance regulation, diversification actually gives you a prudential benefit. So I think, you know, for efficiency and diversification, clearly, I mean, you see pluses and advantages in scale. On the other hand, there are minuses. The first one is the one I mentioned earlier, is, you know, how do you manage complex operations that can be multi-country operations? I mean, isn't there a limit to the complexity that banks can manage, especially, I mean, in sensitive sectors like banking and the financial sector? The second minus is the systemic risk. So basically, if you are going to encourage scale, you are going to get bigger and bigger actors. And, you know, is that creating a systemic risk on your system that you need to mitigate as a policymaker? And third, of course, is competition, with, you know, I would say the inverse relation between scale and competition, which is pretty straightforward. I think, you know, we to focus on those last 2 points, systemic risk and competition. I think, you know, competition is not the business of banking regulators. It's the business of competition authorities. But I think, interestingly, you've seen banking regulators stepping into competition policy, of course, prudently, but nevertheless doing so. I think an important data point, for instance, is the ECB guidelines of 2021 on the cross-border consolidation and bank mergers in Europe, which mentions around, you know, citing all the goals and all the things that the ECB is going to care about in analyzing a merger, the impact on competition. And when you look at FDIC guidelines in the US, it's the same. I mean, competition policy is there. So interestingly, you see competition making forays into regulatory/prudential policy as being one of the things, of one of the elements regulators look at or care about. Now, with respect to systemic risk, I think it's interesting to pause on that topic for a while. I mean, we have seen numerous instances where prudential policy has been discouraging size. In the Basel framework, you have the GC framework. The TLAC framework is limited to GCs. And we have a number of jurisdictions, and I think Europe is also moving in that direction, which have actually two-tier systems, whereby, you know, there's some kind of proportionality rule in which larger banks have tougher requirements than smaller banks. And, you know, not to mention the bank separation issues, the ring-fence regulation we had after the financial crisis, which were also, I would say, creating a clear differentiation between larger banks and smaller banks. I think this, you know, this bias, which I think is clearly there in policy, it's reasonable to ask whether it's been appropriate, and if it's been appropriate, whether it's been not too unbalanced. And of course, we all have in mind the financial crisis of 2008, where you had very large institutions failing. So I think, you know, directly to the point of too big to fail, and directly to the point of having tougher regulation for larger banks. But, you know, equally, we've had the saving and loans crisis in the US and other crises where the issue was not too big to fail, but too many to fail. And where somehow you had, you know, the simultaneous failure of copycat banks, which, you know, had very similar business models. And because of, you know, some kind of macro or transversal or, you know, regulatory issues, were all facing challenges at the same time. So that's, you know, a point in the other direction. Another point in the other direction is the March 2023 crisis in the US, where the SVB and the likes of SVB, which failed, were small to mid-sized banks and not large banks. There was a, you know, a fleet towards larger banks when you look at customer pattern. So when you look at the picture, it's pretty mixed in terms of whether the failure of the systemic risk is more tilted towards the very large banks or the smaller to medium-sized banks. I think it would be a very endless debate to argue on probability of default. So basically, is there a higher probability of default for large banks or smaller banks? Very unable to have a view on that and to be definitive. I think the point we looked at in the past, and especially when we built the MREL regulation in Europe, we discussed the MREL regulation in Europe, was the loss given default. And when you look statistically in banking crisis, you look the loss given default as a portion of total assets, it's actually bigger for smaller banks. So meaning that when a small bank fails, the amount of losses as a relation to its total balance sheet is higher than larger banks. And I think that's pretty straightforward to understand. It's because being a less diversified model, when you hit a shock, the shock has much wider implications and impacts on the individual institution as opposed to a diversified bank. And nevertheless, even though this is a statistical observation, nevertheless, when you look at the requirements, for instance, the MREL requirements, they are progressive in terms of meaning that the share of RWA that you are going to apply as a requirement of MREL for a given bank actually rises with the size of the bank as a general rule. So, I think quite difficult to reconcile with the fact that, with my point on loss given default, and the fact that, losses as a share of balance sheet are going to be larger for smaller banks when they fail. So I think, on this kind of debates, you can argue as to whether, I would say, the bias against, I would say, large banks in regulation is appropriate, yes or no. To conclude, and I'll give back the floor back to you, Emiliano, when we consider those questions about where to strike the right balance between size and systemic risk, efficiency and systemic risk, we need to take into account the specificities of the Eurozone. And those specificities is that we are trying to build an integrated supervisory framework. We have an integrated supervisory framework. And so somehow systemic risk needs to be appreciated not so much, or as much, I would say, at the national level as at the Eurozone level. Not all the system is run at the Eurozone level. We don't have a deposit insurance that is European. But the supervision is European, the resolution is European, and the SRF, the Single Resolution Fund, is European. So again, when you look at systemic risk, you have to look at the right point of entry when we talk about the Eurozone. And the second point is that we need to pursue, as Europeans, and in the interest of the internal market, a policy of financial integration, financial deepening within Europe. And so, again, now when we think about this issue of striking the right balance between systemic risk and efficiency and scale, we need to bear in mind that we need to integrate our financial markets more. So, and we need to encourage that because it's just the macro interest, I would say, of the EU and the Eurozone.
So thank you, Corso. I mean, along the lines of encouraging and creating incentives, we're going to look at follow-up questions. I would like now to give the floor to Sharon, because we've seen that with upcoming financial crisis in the past, more and more we see a trend of bank consolidation, looking at already integrated market like the US, where bigger banks have always been the solution in banking crisis. We've seen recently also in Switzerland, where we ended up with one single mega bank. So now, Sharon, give us a little bit your perspective, the US perspective on both the financial stability angle and this efficiency competitiveness element. Please, Sharon.
Great. Thank you. Thank you, Emiliano, and thank you to EY for the invitation to participate today, and hello to all the colleagues joining online. So to your point, the US, as you know, is a pretty well integrated market, and even then we have seen some bank consolidation. Just kind of statistically, just in Q1 of this year, according to S&P Global Market Intelligence data, there have been 34 U.S. bank deals worth a combined, a little over 1.6 billion, which is a pretty healthy clip and kind of stronger than Q1 of last year, but still not yet the huge wave that I think a lot of analysts were expecting coming off of changing market conditions and perhaps a more favorable regulatory environment. Footnote, as we've alluded to already in this panel, there's of course some uncertainty in market conditions in the near term, given geopolitical fragmentation and some market volatility, which, is likely playing a role in banks taking more of a wait and see approach, or in some cases might foreseeably make the need for consolidation, frankly, more urgent. So given where I sit, as Emiliano mentioned, I'll highlight a little bit more of what we're seeing in the U.S. market, and I'll do it a little bit, I think, in terms of some examples and case studies to give colleagues a flavor of what U.S. Kind of markets and prudential regulators look at when considering bank mergers and when considering financial stability issues, to give folks a sense, kind of, again, almost on a case study basis of how the U.S. market might work. But before I do that, I think one trend, and building on something I think Andreas has mentioned as well, that we've seen for several years now is really kind of technology and digital transformation and the so-called, what I'll call traditional banks and neobanks, although this is really not a clear dichotomy today, to an evolution to adaptability to better avail of new technologies to better serve customers. And we're seeing a lot of this for, like I said, several years in the US markets, and I'm sure internationally as well. There's a natural synergy there with traditional banks, kind of more known for having strong consumer trust, established reputations, better understood regulatory and supervisory frameworks, diversified revenues, et cetera. And then kind of neobanks with a mobile first interface that make a lot of opening accounts, monitoring spending, managing finances, I think a little bit more user friendly, and often without the legacy infrastructure and issues that panelists have mentioned, and they can sort of move a little bit more rapidly. So of course there's a bit of convergence here, and clearly I will note, of course, JPMorgan also has a digital only bank, Chase UK. And with that, let me pivot a little bit more to your question, Emiliano, on financial stability. So U.S. bank merger policy, frankly, is a little bit in flux. There were some proposals that were issued last year that have since been withdrawn in the current administration. And so TBD on specific bank merger policy sort of application. That said, the U.S. statutory framework remains, and I think highlighting some of these considerations can be a good U.S. example, sort of complementing what Corso and Thorsten's comments have been. So in the U.S., similarly, right, we're not subject to just the generally applicable federal antitrust laws, but also a bank industry-specific regulatory framework. So Department of Justice really oversees concentration competition issues, as Corso highlighted, and then also the choirs are really overseen by their primary banking regulator, right? So the OCC or the FDIC in this case, and if applicable, the Federal Reserve for holding company, bank holding company. And what U.S. banking agencies have always had to consider were statutory requirements of competitiveness, whether there's sufficient managerial and financial resources, whether the needs of the community are served, the ability to address AML and other factors. And then post-financial crisis, Dodd-Frank actually made it a statutory requirement for U.S. agencies to specifically consider financial stability implications. The extent to a so-called proposed merger would result in greater and more concentrated risk to the stability of the U.S. banking system or financial system. But financial stability is actually not well defined. And so I kind of took a look at some kind of bigger known examples to see how the agencies thought through this. So one example, ex folks might recall, when Goldman acquired GE Capital's financial assets, the agency found that the proposal would improve the stability of Goldman Bank's funding profile by diversifying resources of funding, and thus increasing stable funding would allow the bank to maintain and further improve its funding profile, which in turn enhanced financial stability. When Morgan Stanley acquired E-Trade, the Federal Reserve indicated that now E-Trade would also be subject to more stringent standards required for G-SIBs, right, like Morgan Stanley, and then Morgan Stanley in turn would have an additional stream of stable revenues from the wealth and investment management business, thus diversifying its own funding structure. FDIC has looked at the resolvability of merged entities when issuing its proposal. So, for example, when SunTrust and BB&T merger created Truist, they assessed whether financial stability considerations were mitigated by the organizational structure, by the expected continuity, salability, and then also the separability in resolution. The OCC's licensing manual focuses on potential challenges, I think many of which have been discussed already, but it includes the increased size of the combined entity, the availability of substitute providers, whether financial distress at the combined entity would cause significant risk to other institutions, contributing to the complexity of financial system, and then again, the relative difficulty of resolving or winding up the combined entity's business in the event of failure. And then one thing I would note, in the US, there's actually an additional safeguard where there's a 10% deposit cap to prevent excessive concentration risk. So there's a general prohibition against banks to engage in mergers who hold 10% or more of nationwide deposits. Now, there is an exception there, being acquisition of banks in default or danger of default, which was the case in JPMorgan's acquisition of First Republic Bank, of course. So, but also on the flip side, as we've just been discussing, right, mergers often have benefits due to enhanced diversification measures, increased scale, gains from technology, resourcing, and operational efficiency. I think gains from, frankly, just learning best practices of different institutions. And then, like I mentioned, in the Morgan Stanley acquisition of E-Trade, regulators here in the US also consider that larger institutions are subject to more stringent regulatory requirements that are intended, of course, to reduce the probability of failure in the first place, and therefore should be positive for financial stability. The additional requirements, of course, include liquidity requirements, capital requirements, recovery plans, in addition to resolution plans. And then I will just note, OCC's order approving JPMorgan's acquisition of First Republic, colleagues have mentioned during the turmoil of the March 2023 events. They specifically considered the financial stability implications of the merger, and there the finding was that it did not increase risk to financial stability for these reasons. One, the merger facilitated the orderly resolution of an IDI in default. Two, the transaction did not materially complicate JPMorgan's organizational structure, interrelationships, or any unique characteristics that would complicate the resolution of the firm or otherwise pose a greater significant risk to the financial system in the event of distress. Three, there would not be a reduction in availability of substitute providers. And then it also noted that JPMorgan is subject to US resolution recovery planning, and that the ability and effectiveness to combat money laundering activities, including overseas branches, continue to be high. So those are just a little bit of examples from the US perspective of how agencies here think about financial stability and competition. Now, just three quick notes on Europe in the May, since I know this is sort of the focus of our conversation. One trend that I am seeing, and it'd be interesting to get colleagues on the ground perspective, right, is that as local governments reduce their stakes that they had in these different national banks resulting from the global financial crisis, whether banks now have more flexibility to pursue strategic shifts and growth opportunities and perhaps boost confidence in the sector. Now, of course, Thorsten mentioned that there's this bank nationalism issue, but at the same time, right, as public authorities remove their prior stakes in these banks, perhaps there's more flexibility. And of course, too, we've also discussed whether there's a supportive or more challenging regulatory environment could be at play. Europe, like the US, has multiple cooks in the kitchen, I think, between EU-wide supervisors and the national supervisors. And then the last point I'll make here is Emiliano, as you know from our many years engagement on the US-EU Financial Forum, I do believe that a strong banking union is good for EU banks and markets more broadly. It would be further supported by pan-European mechanisms like EDIS, which colleagues have already mentioned.
Thank you very much, Sharon. I mean, extremely useful to understand this US perspective and also the regulatory framework. And looking at financial stability, of course, you can also look at some of the incentives in order to have eventually more consolidation. I mean, the last question to all, and I have to say I've been a very bad chair. I will give now 2 minutes each of the panelists to either respond to each other or to ask, to respond to a question, which is the current environment in EU conducive to more bank consolidation? Some of you, and there is a question from Matteo, for example, are there the right incentive now in the banking union SIU context in terms of regulatory and supervisory aspect conducive to that? I remember some SSM blogs. Some of you mentioned the backstop and EDIS. There is a question from Nicolas about the position in relation to the Danish compromise. First question. Second question I would have is the digital fintech competition will push more EU consolidation. And then final question I would have for the panelists is, can EU banks compete in the current EU environment on equal footing with US banks? So opening the floor, 2 minutes each, and then we conclude. Who wants to kick off? Maybe we can follow the same order. Andreas.
Okay, I'm going to concentrate on one of those. And I'm going to put forward my own thesis. And I'm probably the oldest on this panel, so I have the most traditional views. But my traditional view continues to be that in order to be a strong European bank, you need to go through national champions. That has been my view for a long time, and it hasn't really changed. The stronger you are at home, and the more efficient you are, and the better your economics are in this market, it's easier for you to expand into cross-border transactions. So, and if you look through the EU, you know, I only see one very, very strong national champion in Europe in one area. And that is one certain bank. I'm not going to mention the bank, one bank in Scandinavia. But we still have several French banks, several Spanish banks, several Italian banks, several Dutch banks, etc., etc. So my thesis, if I can put one forward, Emiliano, would still be, let's, you know, don't forget that there is an advantage to be a national champion when you want to move into cross-border. That would be my 2 minutes.
Thank you, Andreas. Thorsten, please.
Yeah, so I'll just going to disagree here, just to have a little bit of a debate. And I'm going to come from a different side again, from a different perspective. Yeah, so I think what Andreas is describing is the unfortunate reality right now, but it shouldn't be the reality. I think we should, ideally, we would move away from this idea of national champions more to European champions. I think that is the idea. And yes, of course, you have to have a good starting point. I mean, as a bank, you have to be strong in your home market in order to expand. That's kind of obvious. I mean, but I also think that in order to receive the necessary scale, and again, this comes back to the issue of competing on the same level as the US. I think you need more of the cross-border mergers. We want to ultimately move from national champions to European champions. And of course, this has, again, to do also with the stability aspect. We want to move away from the idea that sovereign and banks are linked on the national level. I mean, that was at the core of the Euro debt crisis. And that, so I'm not actually kind of criticizing what you're saying, Andreas. I'm just saying this is not the way it should be.
But this is not a contradiction, actually. I'm saying we're saying exactly the same things coming from different angles. Yes.
No, exactly. That's what I'm saying too. So we should really hope we can move away from that idea really to the idea that we have European moves. And I think there was this question in the chat and the Q&A box to say, well, how do we overcome this? And I think that's the same debate also applies now to the CMU. And I don't think there are easy options. I think the fact that we have the SSM has helped a lot, actually, the stability of the system, but also in the ongoing push for more a move towards a single market in single European market in banking. Apologies. And I think something similar we need also in the capital market area, a champion for a kind of a single market in different other areas of the financial system. And the other one is the other buzzword, so to say, if anybody has a European bingo card with them today, is of course the coalitions of the willing. So I think that's really what we need. Maybe one last point I want to make. Are we on the same level as the US? So I think I hope I'm not sounding like the elder Cato. So I think we should definitely not follow the possibility of the US kind of loosening up regulation, lowering capital requirements, lowering supervisory requirements, and so on. Yes, it might give a short-term advantage to the US banks, but it might also end up in lots of sweat, tear, and blood. And we know that in Europe, resolving banking crisis is much harder than in the US, I would say, both politically speaking, economically, societally. And I think we should therefore not follow this approach. I think we should think about competitiveness of banks through the cycle, meaning both during the upturn and the downturn. So I think that is so no kind of short-term advantage, but focusing on how can banks best contribute to the economy here in Europe, and also helping in establishing the savings investment unit. That should be really the goal. Thanks.
Thank you, Thorsten. Corso, please.
Yeah, no, thanks. Just very quick remarks, I think twofold. The first one, I think having integrated banks and pan-European banks is an important element to improve the shock absorption capacity of the Eurozone and the broader EU. Through private flows. I think it's really the same thing as CMU. Sorry, CMU used to be the name where I was involved into that. I think it's changed name now, but you know that's I think a key element in making the Eurozone more resilient. So I think it's a public policy goal, not to be pursued at any cost, not to be pursued at the expense of systemic risk, but clearly a policy goal. I think to your question, Emiliano, a question from the audience about, you know, what are the impediments? Is the environment conducive, and what are the impediments to consolidation, and in particular the regulatory impediments? I would tend to say from my own practice that I'm not sure they're Europeans. I think the two main impediments to bank consolidation in Europe on the regulatory side, I'm just focusing on that, are the GSIB buffer, which basically penalizes size. So not European regulation. And second, the ring-fencing of capital and liquidity, not totally a European regulation, because a lot of this has to do with macroprudential tools, which are national. Some of it, I would say, with a European regulation, because the exemptions to solo requirements, you know, are easy for capital when you are in borders, but cross-border more difficult, and the same for liquidity. So, I mean, on that front, I would say it's a more mixed picture, because I think European regulation still has to do a bit on that. Likewise, regulation, which is, although it's a European capacity and it's a European competence for large banks, it's very much, you know, a solo regulation based on legal entities. So it tends to be, I would say, country-based. So, but again, I think the two main impediments, the GC buffers and the ring-fencing of capital liquidity are mainly non-Europeans. So, you know, I tend to disagree when people say that European regulation is the culprit here. I think when you take a broader view, another reason why banking consolidation is not happening, and that's not linked to prudential policy, is product heterogeneity. A mortgage in Germany is not the same as a mortgage in Italy, as in Belgium, and so on. So I think, you know, that's a big endeavor, having products to convert, because, you know, those products, you know, are all linked to our history and national circumstances and so on. But clearly, the more you can do to harmonize the products, be it in banking, retail banking, insurance, the more you favor integration. I mean, the Commission has tried. It's been a very difficult endeavor, but the more you try, the more you succeed, and I think the more you favor integration.
Thank you, Corso. Indeed, before we were speaking about completion of banking union, then we realized it's more a progress. So it's a continuous progress. Sharon, please, for you, the concluding words.
No, thank you. So I think the fellow panelists here are really the EU expert, but I would just say a couple quick things. I do think I agree. I think with what Thorsten said, competition is good, right? I think competition is good for markets. It is good for consumers. And so I think from my perspective, I would really welcome competition. And in the US, for example, there are about 4,000 banks. So it's actually a pretty large number, but has the benefit of I think, very in the privilege of having strong and deep markets. So to the extent, right, European colleagues and regulator supervisors can help build that strong and deep market Europe-wide, including the banking union initiatives that we've discussed, I do think that would go a long way to kind of building up the European banking sector.
So thank you, Sharon. I think it was a very interesting discussion. We touched on many points. We cover almost everything. I'm also pleased by what Corso just referred to now, the product heterogeneity, across market, because this is also a potential driver. I think all of you mentioned barriers or benefits for competition and so on. I have to say, nobody mentioned the benefits to the actual shareholders. So, and I'm looking at the figures of return on equity, because if you look return on equity in the US and EU, there is quite a difference, but it's true. And this is also linked to SIU, the Saving and Investment Union. There are also very positive return for the shareholder themselves. And then I think probably as a concluding remark, and many of you mentioned the nationalistic element or the emotional element of it. I mean, of course, transactions of this type are not only driven by rationality and synergies and effectiveness, but there is also this important component to take in consideration. This emotional element is not only of political nature, but sometimes is also driven by the actual executive themselves. It can also be driven by personal reasons and so on. Anyway, thanks a lot for participating to this panel. I think it was extremely interesting. I would like to thank all participants who listened in for the questions. There were many questions. Unfortunately, we didn't manage to cover all of them, but probably this might be for a future opportunity. And thank you all for participating to the panel. Thank you.
Thank you.
Bye-bye.
Bye. See you. Bye.